Incoming data show that, alongside the strong job market, the U.S. economy has grown at a solid pace so far this year. The value of goods and services produced in the economy, or GDP, rose at a moderate annual rate of 2% in the first quarter after adjusting for inflation. However, the latest data suggests that economic growth in the second quarter has been considerably stronger than in the first. The solid pace of growth so far this year is based on several factors. Robust job gains, rising after-tax income, and optimism among households have lifted consumer spending in recent months. Investment by businesses has continued to grow at a healthy rate. Good economic performance in other countries has supported U.S. exports and manufacturing. And while housing construction has not increased this year, it is up noticeably from where it stood a few years ago. Turning to inflation, after several years in which inflation ran below our 2% objective, the recent data are more encouraging. The price index for personal consumption expenditures, or PCE inflation, an overall measure of prices paid by consumers, increased 2.3% over the 12 months ending in May, that number up from 1.5% a year ago. Overall, or headline inflation, increased partly because of higher oil prices, which caused a sharp rise in gasoline and other energy prices paid by consumers. Because energy prices move up and down a great deal, we also look at core inflation. Core inflation excludes energy and food prices and generally is a better indicator of future overall inflation. Core inflation was 2.0% for the 12 months ending in May, compared to 1.5% a year ago. We will continue to keep a close eye on inflation with the goal of keeping it near 2%. Looking ahead, my colleagues on the FOMC and I expect that with appropriate monetary policy, the job market will remain strong and inflation will stay near 2% over the next several years. This judgment reflects several factors. First, interest rates and financial conditions more broadly remain favorable to growth. Second, our financial system is much stronger than before the crisis and is in a good position to meet the credit needs of households and businesses. Third, federal tax and spending policies likely will continue to support the expansion. And fourth, the outlook for economic growth abroad remains solid despite greater uncertainties in several parts of the world. What I have just described is what we see as the most likely path for the economy. Of course, economic outcomes that we experience often turn out to be a good deal stronger or weaker than our best forecast. For example, it is difficult to predict the ultimate outcome of current discussions over trade policy, as well as the size and timing of the economic effects of the recent changes in fiscal policy. Overall, we see the risk of the economy unexpectedly weakening as roughly balanced with the possibility of the economy growing faster than we currently anticipate.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.